Hello everyone, Dr. Dennis here again. It is time also once again to discuss the next phase of your final project here in Finance 4324 and some tips on how you might go about doing it. By now, you should have drafted a general outline for your project based on the assignment requirements. Hopefully your outline looks something like this. Part 1, an introduction to the financial crisis and role of the banking sector. Here you should give a brief overview of the 2007 through 2009 financial crisis and its impact on the housing market. You should also highlight the significance of this event in economic history. Analyze how the banking sector contributed to the onset and escalation of the crisis, and be sure to focus on specific banking products such as subprime mortgages, mortgage-backed securities, and collateralized debt obligations, also known as CDOs. The financial crisis of 2007 through 2009 was significantly fueled by the actions and practices within the banking sector. For instance, the widespread issuance of subprime mortgages, often bundled into complex financial products like mortgage-backed securities and collateralized debt obligations, CDOs, all led to heightened risk exposure for financial institutions. These products were marketed as low-risk investments but were actually backed by risky mortgages, contributing to the destabilization of the financial system. Part 2, the Federal Reserve and the U.S. government response. In this section, you should evaluate the tools and actions deployed by the Federal Reserve and the U.S. government both during the crisis and immediately following it. Discuss whether these interventions ultimately fostered a safer and more secure financial system or not, and be very detailed in your explanation. During the crisis, the Federal Reserve and the U.S. government implemented various measures to help stabilize the financial system. These included unprecedented monetary policy actions, such as lowering interest rates and instituting what were known as quantitative easing programs. Additionally, government interventions like the Troubled Asset Relief Program, or TARP, aimed to provide liquidity and support to struggling financial institutions. However, the effectiveness of these measures in creating a more resilient financial system remains a subject of debate. Part 3, Pre-Crisis Loan Policies and Risk Management. In this section, you should evaluate loan policies and risk management strategies employed by banks prior to the crisis. This part of your project should also assess whether these policies exacerbated the situation or made it worse, and provide specific examples. Leading up to the financial crisis, many banks adopted relaxed lending standards and inadequate risk management practices. For example, some institutions engaged in predatory lending, extending mortgages to borrowers with poor credit histories and limited financial means. Additionally, the securitization of these risky loans obscured their true risk profiles, leading to widespread underestimation of the systemic risks involved. Part 4, Legal and Ethical Issues. In this section, your paper will examine the legal and ethical dilemmas stemming from moral hazard in the banking sector. You will also analyze the decision to allow Lehman Brothers to fail while providing bailouts to other financial institutions. The financial crisis exposed numerous legal and ethical issues within the banking sector, particularly concerning the concept of moral hazard. The decision to allow Lehman Brothers to collapse while orchestrating bailouts for other major banks raised questions about fairness and consistency in government intervention. Critics argued that this selective approach contributed to market uncertainty and undermined public trust in the financial system. So that's an overview of the general outline you can use to help organize your project, where of course the bigger concept is the topic itself, the financial and housing crisis and the Great Recession that followed. Remember, this project does count for 20% of your entire course grade, so do your best work. Do not skip the project. You shouldn't skip any projects or any papers, but especially not this one. As always, you should use descriptive headings and subheadings to organize your paper. It should very much read like an article you would pick up in a professional journal, an industry magazine or something like that. So organize accordingly. What follows are some thoughts specific to the second part of the project, part 2 of the outline, which requires you to evaluate the tools and actions of the Federal Reserve and the U.S. government during the crisis and post-crisis. You should also comment on whether these outcomes created a safer and more secure financial system, and if not, why not? Provide as much detail and specific examples as possible. As a result of the 2008 financial crisis, many businesses and individuals were left with huge losses. In order to limit the damage, both the Federal Reserve and the U.S. government took numerous steps to intervene in the economy. These interventions ranged from providing liquidity for troubled banks and other financial institutions to introducing new regulations aimed at preventing similar crises from occurring in the future. The primary question to be explored here is, were these actions sufficiently robust to both aid in crisis recovery and prevent similar situations in the future? This is a key undertone and hopefully part of the significant conclusions you will draw after you've put your entire project together. The Federal Reserve intervened during this time by providing emergency lending programs, which helped some of the larger banks avoid bankruptcy. These programs included the Troubled Asset Relief Program, or TARP, Term Asset-Backed Securities Loan Facility, known as TALF, a variety of other Federal Reserve programs, and several housing market stabilization efforts. Larger banks benefited from these programs most, though some banks were allowed to fall into bankruptcy and go out of business. These failed banks put thousands of people out of work and sent the already recessionary economy into a tailspin. The economic ripple effects were severe and widespread. Other businesses were unable to survive and went out of business as well. This resulted in massive layoffs across the economy and further reduced economic activity, leading to the 2008 through 2009 Great Recession. During the 2008 housing crisis and subsequent recession in the U.S., several large emergency lending programs were instituted to stabilize the financial system and support economic recovery. Among the notable programs was the Troubled Asset Relief Program, or TARP. TARP was enacted to purchase troubled assets, particularly mortgage-backed securities, from financial institutions to stabilize the banking sector and restore liquidity. It also provided capital injections to banks to prevent systemic collapse of the banking system. Term Asset-Backed Securities Loan Facility, or TALF. TALF aimed to revive the securitization market for consumer loans, such as auto loans, student loans, and credit card loans, by providing non-recourse loans to investors to purchase asset-backed securities. Other Federal Reserve emergency programs. The Federal Reserve implemented a variety of emergency lending programs, including the Term Auction Facility, or TAF, Commercial Paper Funding Facility, CPFF, and Primary Dealer Credit Facility, PDCF, to provide liquidity to financial institutions and support credit markets. The housing market stabilization efforts included initiatives such as the Home Affordable Modification Program, or HAMP, and the Federal Housing Administration Refinance, and several federal FHA programs were introduced to assist struggling homeowners by modifying mortgage terms and facilitating refinancing. All of these emergency lending programs played a crucial role in preventing a complete financial meltdown and supporting the recovery efforts during one of the most challenging economic periods in recent history. Also, another mini tip, notice I have sprinkled several references throughout my slide deck. You may want to go and find those on your own and see if they fit the content list that you are putting together for your project as well. One of the most significant interventions that the Federal Reserve took during the 2008 situation was to reduce its benchmark interest rate from 5.25% to nearly zero. This move aimed to stimulate economic activity and encourage borrowing by making loans cheaper for both businesses and consumers. In combination with other measures, this action helped improve liquidity in the financial system and mitigated some of the worst impacts of what generally became known as the 2008 crisis. The U.S. government also responded with several key interventions. Mentioned previously, the most significant of these interventions by the government was the Troubled Asset Relief Program, or TARP. This program provided $700 billion in 2008 to bail out troubled companies and banks with the aim of providing capital to the financial system and preventing further losses. TARP further aimed to provide capital to the financial system and prevent losses by offering assistance such as purchasing bad assets from banks and providing loans or loan guarantees for businesses that were struggling due to the crisis. Additionally, TARP also provided funds for foreclosure prevention programs, consumer credit counseling services, and other initiatives designed to help individuals who were affected by the 2008 crisis. The Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010 as a response to the 2008 financial crisis as well. This act introduced a number of regulations aimed at preventing similar crises from occurring in the future. Key provisions of this act included increased oversight of banks and other financial institutions, stricter capital requirements, greater transparency for derivatives trading, and enhanced consumer protection measures. Additionally, it established an independent body, the Financial Stability Oversight Council, FSOC, with authority to identify risks that could potentially threaten the stability of entire industries or even the economy as a whole. These reforms were designed to ensure that businesses take greater responsibility for their actions while protecting consumers from unscrupulous practices by banks and other financial institutions. While it can be said that both the Federal Reserve and the U.S. government took steps to intervene in 2008, their effectiveness in terms of preventing similar economic crises in the future has yet to be seen. While these interventions did help stabilize the 2008 crisis, they may not be enough to ensure that similar events don't occur again. It is therefore important that we continue to analyze and evaluate economic policies with a view towards preventing similar disasters from occurring in the future. Here are several references that were used to supply the content for this presentation. Feel free to locate them on your own and potentially incorporate relevant paraphrased content into your project and include them as needed in your reference list as well. This concludes this live chat segment. For those of you who are on live, we have time for Q&A here at the end. Otherwise, feel free to play back the recording as often as you need. You should also download my slide deck from the course announcements. See you online.